one thing people do in a portfolio is they assume static correlation between stocks and bonds. That works when growth is the dominant factor.
The stocks go up when the bonds are down and vice versa.
But not in the world where we're dominated by inflation and Fed action, because both of those assets are long-term in nature. And so they're going to be discounted by higher and higher rates, driving today's price down. And this was the 1970s. In the 1970s, stocks and bonds moved basically perfectly correlated. And so you have a moment where it's much more necessary, if you're going to have a healthy portfolio, to think about what can I add that is actually different.
CEO and co-founder.
Joe Lonsdale, the founding partner of
Palantir co-founder Joe Lonsdale.
I'm excited to introduce you to my friend Jake Miller today. Jake and I co-founded Opto together, a financial technology company. We're facing some really complicated financial markets, economic challenges, debt challenges in our government over the next decade. Jake has some great insights about how to navigate these times ahead, and he's a fascinating person to hear from. I'm Joe Lonsdale. Welcome to the American Optimist. Jake Miller, thank you for joining us today.
Thanks for having me.
Jake, you're the co-founder of Opto, and you're currently running Opto's advisory practice. We're here in Miami today. Where are you in Miami?
We're here for the Nitrogen Conference, brings together hundreds of RIAs and tech solutions to talk about how to improve the whole space for advisors and their clients.
So talking to hundreds of RIAs, obviously you want them aligned with Opto. Tell us about your background before we jump in. Where you grew up, where you went to school?
Yeah, so I grew up in San Francisco, which I think from an early age got me interested in investing. I saw our next door neighbor go from driving a beat-up old Honda to a Ferrari, back to a beat-up old Honda over the span of about 18 months in 2001. And I thought, that game looks fun, but I should learn how to play it better than him. So I've been investing since I was about 8 years old. Studied at the University of Chicago, or studied economics and classics. And then right after college, went to work at Bridgewater Associates.
Classics, huh?
Yeah.
Personal interest?
Personal interest, and I often say, I think I learned more about investing in that major than the econ major. So much of academic econ right now is about solving for some global maxima using physics equations that really don't belong in our economy. Whereas studying classics and history, just seeing how civilizations grow, thrive, and ultimately fall, has a lot more bearing on how markets are evolving day to day.
Learning more about human nature and civilization is really what we're doing here. Oh, that makes sense. And so you were at Bridgewater before, right? What did you do at Bridgewater?
So I was an investor there. It's an interesting company. It's really only three roles. There's management associates, technology associates, and investment associates, outside of some of the core operational paths.
So raising money and stuff too, probably.
Yeah. And wore a couple hats there, worked with some of our big clients, sovereign wealth funds, pensions, on how am I going to meet my goals? What's my probability of success? How can I up that?
So Bridgewater is famously a very unusual place.
Yes.
They ask you lots of questions transparently. They criticize each other openly. I mean, did you learn any positive lessons from that? Did you learn negative lessons from that?
Personally, it worked great for me. I loved it. I think it's how I act most of the time anyway. And so rather that being like, oh, that Jake, he's kind of weird and speaking his mind too much, it was very much nurtured and appreciated.
It's a culture where you speak your mind, you confront things that are broken. I like that.
Yeah.
Were there any downsides to how it worked?
So in terms of that culture, at its emotional level, I really can't say anything but good things about it. Where I thought we missed the mark sometimes was just how it was implemented. There were a lot of tools and structures and red tape put in place, which maybe at the company that size, it's unavoidable, but it felt like too much of our time was spent on talking about how to talk about problems than the problems themselves.
It's one of the biggest hedge funds in the world, if not the biggest. It's done very well. Some people say it's like kind of cultish how it works, but so overall, you think it attracts really good people and has a transparent culture? I
think so, and it's something we try and recreate at Opto, and I imagine it's true across top places in technology.
Some people say Palantir is a cult too, by the way, sometimes. So I guess people say that about things that are successful with their own cultures.
They look too good from the outside. You throw some stones, but I think what it does a great job of is great people want to work with other great people, and organizations can really die when you have someone who's a star and they see other people around them underperforming and that not being rectified.
If you don't get rid of the underperformers, the stars leave, and then you can't
exactly
have a great place.
What can look intense and a bit inhuman in press is actually really positive, because if someone's not going to work there or anywhere that has a really high standard, it doesn't help anyone to wait 9 months.
Yep.
And it can be really hard for a culture to sustain those people.
It's a tough lesson to cut people quickly that aren't working out.
Yeah.
And so you said you were an investor from a young age. I actually was an investor in the 90s in high school as well. bought a BMW with some of my tutoring earnings that I made money on in tech stocks. It's very lucky I bought that because then the tech stocks all crashed afterwards, obviously with 2001. What kind of investing were you doing when you were younger?
So I started, I think, where most people don't. I think early on, most people focus on the equity markets, which there's a ton of opportunity there. I was always much more interested in currencies and bonds, so became a student of macro, reading a lot of great thinkers there early, and I really like those markets because in the public equity markets, everyone is there to make a profit. You're competing against every analyst and a hedge fund. In bonds and in currencies, they're non-economic actors. You have the Fed, who's not trying to make money. You have people just trying to do currency transactions.
You have big, dumb institutions that are forced to buy bonds.
Exactly.
Yeah, you have people just trying to trade. So let's talk a bit about those markets. I obviously was in macro as well with Peter and Clarion and whatnot, and we had some good years there. It's very interesting right now. We have the long-term bond, going up. I think almost 5% now, I believe, which is unprecedented for a very long time. A lot of people speculating China has been selling / not buying as many things in general with their troubles and also their antipathy towards us these days. And it's actually quite scary. Like our debt payments are having to go way, way up with these higher interest rates. It's I think it's $1 trillion now, but it gets to $2 trillion pretty quickly over the next few years if we don't fix it. And it seems like there's some danger of a spiral out of control where these these rates can go a lot higher. Now that said, the dollar's gotten surprisingly a lot stronger more recently. Maybe it's like is it the strongest of a bunch of bad options, or what's going on here?
Yeah, I think that's what's going on. And so at the broad picture level, it does look pretty bad for yields to go up from here, with a huge amount of fiscal issuance happening and fiscal spending that's not really backed by increase in revenue on that side. So it's going to be an expansion of the deficit. Combine that with pretty bad conditions for demand where I think this is part of the dollar strength. If I can earn 5-6% on the short end, why would I buy 10-year bonds right now?
JP Morgan's paying me 6% right now.
Exactly.
For risk free. I was gonna build a bunch of buildings near East Austin where I was gonna try to make an investment there, and the paper return when we mapped it out was about 3.8% yield. Money sitting in the bank makes 6% yield. This is what the Fed's doing. They're slowing down the economy and making it so people like me don't have the incentive to build because it's a waste of money.
Exactly. And I think that also speaks to the dollar strength, where if I'm sitting in Europe, Japan, other places in the developed world, I'm getting, what is, at least in terms of getting dollars back, risk-free payments of that amount. It's hard to beat that really anywhere in the world at that level of risk right now. Now, the other half of this, and we have an expression in macro, in the end, they always print money. So what's going to happen if we keep running up the debt like this? Eventually, you're going to have to print to solve that, and that will be inflationary.
Who is going to buy all this debt? There's going to be a lot more. We're $33 trillion of debt right now, I believe, something like that. The deficit, which is the amount we're losing per year, is it a couple trillion now? Is what I understand?
A couple, and probably going up from there.
Probably going up. It's something like our spending is it's back of the envelope 6 something, and our revenue is 4 or something. Yep. So it's like about 2. But then of the 6 something spending, over $1 trillion of that's debt, and that's that part of it's gonna double probably. So you can't even cut that. You have to only go up. Entitlements can't really be cut very easily, I guess, especially not right now in DC.
Yeah.
So I mean, where does this go? Do we just get into an emerging market like debt spiral, and interest rates go way up, and there's massive inflation? They print lots of money, and gold goes up. I mean, this is like the silly gold bug argument we've been hearing for 20 years. Is it finally going to happen, or what's going on here?
Yeah. So this is a prototypical long-term debt cycle. We talk about these a lot at Bridgewater. There's a short-term cycle, usually lasts 3, 5, 7 years, and there's a long-term cycle, which lasts much longer. As at the beginning of the cycle, debt levels are low, and so it's easy to add debt. Interest rates can climb, and you can still want to add debt.
So what's that longer-term cycle? What are the years you're talking about now?
It takes about 30 to 40 years.
So kind of from the early 1980s, we had very high rates.
And now we've been declining, and now we're at the bottom.
The 2020 was like the bottom, basically almost 0% for a long time. I've observed for 10
yield,
years.
But we're still dealing with basically the hangover effects of that. And so the government replaced private spending in 2020. That's in large part why the economy kept growing despite the contraction in consumer spending with COVID. Government gets spending. We're now getting into a place where, as you correctly mentioned, that debt service becomes a huge part of the deficit. And the Fed can either raise rates and increase the government's own spending on that each year, or cut rates and risk running inflation, which will drive that up even further. And so it's pretty lose-lose. Ways of getting out of it would be a significant restructuring of how we spend, but as you noted, it seems unlikely.
So we need either political
climate,
willpower to restructure how we spend, or a crisis.
Because
you can see, it feels like we're on this path, and the path keeps getting narrower and narrower and narrower, and we've slipped off towards the inflation side, and then we're climbing back on. but they're going to slip off the other side.
Yeah, I'm not a golfer,
yeah.
but I usually describe it as putting on a ridge,
You gotta get,
which I hear is hard.
Right.
You're trying to walk the Goldilocks path. And speaking of American optimism, I think that's the only way you can describe a really positive path out of this, which I think will need budget cuts.
Well, there's other ways you could do it too. I mean, AI could just solve everything, Jake. We could just pray to the AI gods and then and put our heads in the sand. This is apparently what a lot of my tech friends are doing.
But unless AI spends money, it's not going to improve the deficit.
You never know.
You never know. It could.
There's some pretty.
It could already be spending
some
money.
pretty clever agents out there.
Yeah.
But I mean, AI aside, you either need to restructure spending completely, which actually I don't think it's that hard substantively.
Yeah.
I can make a plan for how we're going to only spend $3 trillion
And
or
deliver
$6
the
trillion
same quality
and deliver same
services.
quality services by having competence and accountability and firing a lot of useless bureaucrats. But assuming that we don't put dictator Lonsdale in charge here, because that's not how our country works, and that these guys can't get their act together in D.C., then there's going to be a crisis instead. What does a crisis look like?
So my guess is, and this is just a guess, and he who lives by the crystal ball will eat glass, but that it looks more like a slow bleed out than one sort of imminent moment. Of course, there will be shocks, but I think what it looks like is for a protracted period, 12, 15 plus years, rates are higher than they would otherwise be because there's this big gap in demand for bonds and exogenous demand. So similar to your example of that housing development, if because the government is spending too much and not matching that to income streams for years and years, we have just elevated bond levels exogenously, that's going to really hurt the real economy.
Yep.
It might not happen all at once. It might, but I think it looks more like it's just a higher cost of capital.
Almost 5% already on the 10-year and long bond is already probably impacting things very negatively.
Oh yeah, I mean, no one has an incentive to refinance. It is very hard if you got a mortgage anytime in the last 15 years to think about moving right now, and housing activity is a major driver of economic growth.
I guess some people would tell me, well, Joe, these are normal rates if you go back in time, like 20, 30, 50, 60 years. These are normal rates now. But I guess the question, do we blow through them and go to higher? But you don't think there's any.
And I
you
don't
think there's near-term crises, but you think this is a longer term. This is a 10-year thing.
I think this is a longer term thing. There will be bumps in the road for sure, and we'll probably have more bank issues that will be symptoms of the disease, but I think the disease is much more long-term in nature.
So let's jump to Opto. Opto is a company that I'm involved with as well as chairman, and there's trillions of dollars managed by family offices and RIAs, tens of trillions in the U.S. of dollars, and the majority of this money is mostly focused on like the easier to invest in things, which is mostly like public stocks and bonds, and there's some good things to do there. But there's this whole world of alternative investing, which is venture funds, PE funds, private credit, infrastructure, and so you're helping people build portfolios to access alternatives. And so first of all, why is that a good thing for people to do now? How does this macro tie into that? Like connect this to first.
Yeah, so I think it's two-sided. One is when you look at conditions like this that are really bad for stocks and bonds at the same time. One thing people do in a portfolio is they assume static correlation between stocks and bonds. That works when growth is the dominant factor.
So basically, if you buy stocks and buy bonds, in a lot of worlds, the stocks go up when the bonds are down and vice versa.
But not in the world where we're dominated by inflation and Fed action, because both of those assets are long-term in nature, and so they're going to be discounted by higher and higher rates, driving today's price down.
Yeah, so last year people got crushed.
Exactly.
Only on stocks and bonds they got crushed. And if this is a 10-year thing, there could be a lot of years where both of those happen.
And this was the 1970s. In the 1970s, stocks and bonds moved basically perfectly correlated, and so you have a moment where it's much more necessary, if you're going to have a healthy portfolio, to think about what can I add that is actually different.
If you don't want to lose on both sides of what you own, you have to have something that's less correlated. So,
Exactly.
but a lot of people say, well, everything's correlated. Like, why is it less correlated? What are the things that are less correlated? How does this work?
Well, so the core thing to me is finding alpha. If I just went out and bought every private equity-backed company, or even all private companies in the U.S., I would expect that to look like a market return.
Alpha is for the people listening, is the return over the expected return of the asset class. So you're actually looking for like real skill or real advantages of some sort.
Exactly, because in an environment of high interest rates, you would expect just beta returns, market capture returns, to be lower.
Beta is just the returns of the market, whereas alpha is the gap.
If I walk down the street and I ask three business owners, how much can I invest, or I want to give them a loan, average that over the whole economy, that's beta.
Beta's just doing that on average. Got it.
Yeah, and that thing will go down as the cash rate goes up, for the same reason we just talked about. If I can get cash here, why would I do this thing? Mm-hmm. And so in those environments, you really want to find alpha. And if you find it, it is by definition uncorrelated, because it's a zero-sum game. If someone's winning, it's because something else is doing poorly. Which means that you're not looking like the market.
Is that true? Don't people just create wealth sometimes? So is it because someone's doing poorly?
So when we apply the alpha framework to private markets, it does get a little tricky, because imagine you had two founders, they have a stellar idea, no one's funding them. Someone sees the opportunity, sees their potential, their skill as leaders and founders, and backs that, and it goes from pre-money of 10 million up to 5 billion. I think the sort of naive academic thing would be to say, yes, it's alpha. The founders lost to the backer, but it was never going to get off the ground without them. Yeah,
of course. So it's not. Yes, you don't really want to think of it zero sum in the real world, but this is the useless academic equations that you're talking about earlier.
Yes.
So we probably should just think of it as positive sum.
I would think about it as positive sum, but uncorrelated, because it's about an individual skill of a manager in picking those bets, backing the right people, having the network to find the best talent, which shouldn't look like overall economic conditions.
So overall, private markets have outperformed the public markets the last decade or two. Obviously, there's certain people who have better access in the private markets. So I've noticed that first-generation entrepreneurs who've been successful tend to have networks, so they tend to get better access to things. That's not always the case, but then on average, like especially in their industry, they're gonna have access to the best things, and they tend to outperform. You see a lot of like Eric Schmidt's family office or Iconic, with all the tech guys in it, they have access to great things. And then there's other industries, if you want to invest in the very best alpha for energy markets, you probably are going to have a big advantage if you're one of the big Texas families and you know everyone there, or things like that. And so, first of all, like how do you get access to the best things? Is it through these different networks? What is it through?
Yeah, so I have a really simple framework for outperformance. I like to make everything as simple as possible. I think there's really only 4 ways to outperform. You need to have a unique information, unique access, unique insight, or have luck. The first 2 are illegal in public markets, but they're the lifeblood of private, where this
is a really important point. So in public markets, you're not allowed to have inside information. In private markets,
or unique access, everyone has to have the same deal.
Everyone has the same access and same deal. But in private markets, you can make your own deals, and you can know things other people don't know. And in fact, not only is it not illegal, if you're not doing it, you're probably
if you're not doing it, you're not getting the deals. And so it is the networks, and it's also the value that investors can bring to the table. So, to your example, if I'm a big Texas family and I have connections in logistics or oil, and I'm trying to work with a manager
or political, of course,
but we try and forget about that piece.
Unfortunately.
But if I'm talking to a private equity manager who does infrastructure in the oil and gas space, having them as an LP in my fund is going to be really additive to my portfolio companies.
Yep.
And so that's another place where it really is positive sum, where that unique information that family holds can get used to build better companies tomorrow.
And so Opto is tied into these networks, and then of course, I know one of the main things is you try to do it in an aligned way where Opto makes money when your clients make money, because you take a very, very tiny bit of the carry, I guess, over a certain amount is the main thing.
Exactly. When you look at the space today of who's been marketing to RIAs and how they're marketing, it's a brokerage-based business, so charging either a placement fee to the funds, and the best funds aren't going to pay the placement fee.
This stuff drives me crazy. They're basically getting paid to sell them third-rate stuff.
Yep.
And they make money because they get paid more money by people who desperately need to sell their funds.
Exactly. Who's going to pay 5% placement? It's the person who can't hit their target.
It's just crazy to me. People would want to buy things that people are being paid tons of money to sell them, because it's obviously investment-wise, you're just like, there's just a gap there. So it's like you're leaving money on the table.
And this is a big open space for us, because most of these platforms have been built for the brokers, and brokers just get a percentage of the transaction, and so they don't really care if it's good or bad. Opto's a fiduciary. We manage these funds on behalf of our clients and are held to the fiduciary standard, not just fair dealing.
Let's go back to the macro stuff briefly with Opto, because I think this is one of the really interesting questions right now. So we have this very scary 10 years ahead. You already have rates going way up. You have all sorts of challenges in the markets. What should you be investing in alternatives based on a macro perspective now? Like alpha, sure, we want to invest in the most skilled people, but like which of those areas do you target? How do you think about it?
Yeah, so I put it in the context of this year. The Fed has raised rates significantly, and on top of that, banks have tightened conditions, both in the back of regional banking stress and the Fed coming in and saying, like, get your house in order. The effective rate gain has been probably close to double digit now when you combine those two factors.
Explain this again. So the Fed raised rates from near 0.5% to 5.5 or so
5.5
now.
5.75.
That's about 5%. That's 5% of rate hikes. And what's the other rate
banks
hike?
take that and they say, well, I need to earn a spread, so I'm at least going to increase by that much. But also risk in the economy has gone up. The Fed is telling me to raise standards. So the spread they charge on top of that is going to increase. In that context, what we look at is what spaces are going to be most attractive and have best opportunities for investors as capital pulls back. And there's really three pieces that we are particularly excited about right now. One is in the private credit space. When banks step back, more specialty lenders can step in, and they can step in at more attractive rates and better risk standards than they could before. Now, there's a little bit too much hype in this space right now at an aggregate level, and a lot of these registered liquid products are being marketed to RIAs and their clients, and we think there's more risk in those than people assume, because once you're in a liquid product holding a liquid underlying, you have a lot of counterparty risk. That said, in more specialty areas of private credit, asset-backed finance, certain parts of the real estate debt market, you've had the big buyer of banks step out, and the folks who are stepping in are able to get really attractive rates of return.
This is another big trend in our economy, is that banks are regulated in whole new ways that makes it really hard for them to do things. And
Exactly.
so alternative credit can go in and do those things and get much better yields for safe stuff.
Yeah, as an example, there's a firm we know of that it was part of an Australian mega cap commodity producer. They spun out and moved to the U.S. Same business, profitable, great company with a long track record. They don't have 3 years of U.S. audited financials because they spun out last year. No bank will give them a loan. So if you have the capital to step in and the right partners who can assess the quality of that team, opportunity really abounds right now in a way that would be harder when capital's kind of flowing everywhere.
Yeah, there's a venture company I know that helped build a bunch of different companies, and they had shares in a bunch of different things, and the estimate was the shares are worth somewhere between 200 and 500 million, and they wanted $25 million, and they ended up having to pay over 20% interest rate on the 25 million, even though like it seems like if worse came to worse, like the downside, their portfolio is going to be able to easily cover that 25 million. So private credit's one of the areas
private
you guys
credit's one. Another big one is specialist private equity. And what I mean by that is, how did you win a deal in the upmarket? You wrote the biggest check at the highest valuation. That didn't always mean you were the best operational investor. And so seasoned private equity with the experience of helping teams get through these higher cost of capital periods and portfolios that can be additive to one another to help reduce costs and get people through the next few years, they're winning deals now, even if they're writing the lowest valuation. So that's a really interesting area to us. And then early stage venture opportunities. It feels like they haven't been this many in years, but a little bit more common sense is returned to the market. You have enough time to do a full diligence process, do customer references, really get to know the founding team in a way where when you had a week to turn around in 2021, that was a lot harder.
So more disciplined, strong venture investors earlier, still going to be alpha over the next decade. There is the idea, but make sure you're in the ones. There's a lot of autocorrelation in that assets, so make sure you're in the ones that know what they're doing, I guess.
Exactly, and the autocorrelation point in venture is key because the best founders know who the best VCs are, and that word gets around, and so you're going to just see that deal flow.
People want to work with people they've worked with before who backed their last companies,
Exactly.
and they know. All this is the macro side, and then on the other side, like how do you educate the RAs about what's going on? How do you help them do this easily? Is this a big stressful thing for them to engage with? How do you make it easy?
Yeah, so a lot of them have a bad experience of alternatives more broadly coming in because there were a ton of hedge funds in the mid-2000s that didn't do so well. And a lot of these can be black box strategies. One thing in our advantage is private markets are, at the end of the day, relatively simple to explain. I'm either buying a good company at an attractive price or lending to a good borrower at an attractive rate. Now, obviously, there's intricacy into how they pick those deals, price them, et cetera, but the baseline is much easier to understand than I have a black box that trades currencies.
Yep.
On top of that, we really try and get them in the room, both virtually and physically, with those top allocators you mentioned, top multifamily offices, single-family offices, seasoned allocators, less so on the institutional side, but people who really understand what it means to manage wealth and how they've done that successfully at the average family office holds about 30 to 50% in private markets, and so there's a ton of experience that they can share with our users.
That makes sense. And then is there some way to make it easy? I know when you buy public markets, you just click buy on Schwab or E-Trade or something, or Robinhood, I suppose, if you're the younger generation. Like, what are you doing on? Can you just click buy on these alternatives too, or is there like 100 pages of paperwork, or how does it work?
Yeah, this has historically been really painful. We solve this in two ways. One, our primary way of doing business is we build custom funds with RAs. This allows them to take their principles, values, views, as well as input from us on what we're super excited about and create a wrapper that will hold 5, 10, even 15 managers at a time, and it'll be just one subscription document to get access to all of them. And it'll also be at a minimum that allows even folks on the smaller end of the wealth spectrum to get diversified access to privates. Now, that one subdoc is made a lot easier because we integrate with reporting systems, custody, CRM, and so the subdocs become 95% pre-filled. The RIA just has to come in and basically click generate documents, and it's all via e-signature. I know firms that are still using fax machines.
Yikes.
So it's
so
not,
basically technology makes this all a lot easier, and that's your job.
and the information flows correctly, which is really important. If it's on paper, you can easily miss a K1 and misfile your taxes. You can not know where performance stands when manager's late. How do you talk about that? We've built Rails so that every relevant piece of information shows up T+1, and it'll feel a lot more like what you're used to.
That means the
private
next day,
markets.
which is fast. And I guess I know you have a lot of content. You're interviewing managers. You're teaching.
Yes,
them
we've
and their
filmed
clients.
over 100 videos now. I've written about 75 articles, as well as about 25 primers. What are capital calls? What is a subdoc? Stuff that maybe you don't want to read more than once, but it helps advisors get comfortable and confident to go talk to their clients.
Is that all public on the Opto website now?
A lot of it is public on the Insights page. We can't market funds publicly,
Got it.
but anything that is not
So
specifically fund literature,
once they're an REA, they can sign up and
you
do
can
it.
see everything. Yeah.
Got it. And so one thing I want to ask is we started American Optimist to push back on a lot of the cynicism and pessimism in our country. I'm curious, what makes you optimistic for the future, Jake? Like what innovations, fintech beyond, what are you excited about these days?
Yeah, and you and I have had this conversation a few times, and it's, I think, the most important conversation that we can have right now because I think it impacts our political discourse, how people interact with each other, where people are spending their time. I think there's a fundamental misconception, which is that if someone is doing well, someone else has to be doing poorly. It's this, sort of zero-sum thinking that leads to people rebelling, thinking that the evil people are the people who are making money, when in fact, those are usually people who created something of value. And as long as we think that way, we're going to stifle the discourse. And so I think that is on entrepreneurs like myself and you, with all the things you do, to get out there and say what the real situation is, which is market-based economies have generated more wealth, have created much better health outcomes, empowered people to be able to live a fulsome life than any other system. And so what makes me optimistic is, one, I don't see that going away anytime soon, despite the messiness of our discourse in its fundamental form. And I think America is, leagues ahead of the next country in terms of still supporting that, even if the discourse is destructive to that. But then on top of that, we operate in a space where we get to see what's on the cutting edge. And when I look at advances in medical science and biotechnology, in core infrastructure and hardware that goes into the electronics we use, obviously I think it's too early to say where exactly it'll show up, but the potential for AI to reduce crappy work for people. Like, there's work that computers are good at and work that people are good at. A lot of jobs are work that is really better suited to a computer. Hopefully we can free those people up to have more meaningful jobs.
What about when it gets much better at us than talking back and forth on podcasts, and it makes better jokes and it makes everyone laugh better? Should we just let the AI do more for us?
I think that'll be the fundamental question for the next few years. I'm not too worried yet. I think that there is a piece to being human and being able to work on unsolvable problems that computers are not
yet able to do.
Now, I don't say they couldn't get there, but for now, we see this all the time, the human touch, just being able to connect with someone, being able to facilitate those networks is not something that really can be reproduced at scale for the time being.
But you're overall optimistic. You think, we obviously have a lot of challenges and problems in this country. You're optimistic in markets innovation. I agree. I think the alternatives world you deal in is basically getting money towards really smart, solutions-oriented people, and the more we can get money towards these people, the more we can just basically confront all the problems that we care about.
And I think that's why I'm so optimistic. I see the smartest people trying to innovate on how capital is deployed. So a venture capitalist is finding innovators of companies. We're working with a lot of managers who I see as capital innovators and are finding new ways to deploy capital more intelligently, get good ideas off the ground quicker, and are largely succeeding.
As long as the government doesn't break our ability to get money towards like smart people working on these things and like to do bold new things where we're building all this stuff, then I think we're in a very bright spot. I know you're also an advisor to UATX, and you're excited about the talent work there. Like, tell me a little bit about your thoughts on education you wanted to mention.
Yeah, that is another reason I'm optimistic. I think that project's going to set a new standard and hopefully improve the whole system, even as it does an excellent job of educating people themselves. But I went to University of Chicago, which on the national stage is actually a pretty balanced place, but it still had a ton of dogma and its own issues. What I saw most fundamentally, though, was largely, especially in econ lesson classics, they teach you how to solve exercises, which can be fiendishly complex, but there's a definite answer that you can arrive at. Computers are really good at exercises. Problems don't have a definite solution, and so you need to think creatively. You need to be comfortable making decisions with incomplete data, and that there's not going to be a right answer. There's going to be a bunch of answers, and you need to use your intuition as a human being to pick.
Yeah, looking at problems in our society, understanding them, and deeply talking about them, debating them, figuring out how to confront them. These are things universities could do a better job teaching us.
Yeah, and so I'm really excited that someone is trying to fix that and create a actual economy of ideas where students can learn that answers usually aren't very simple, and you're not going to know the right answer. I think this speaks to that previous point of it's very easy to say XYZ problem in the United States is there because capitalism, and A, no one is checking that, which they should be, but B, what a simplistic way of thinking. These issues are generally nuanced. There's a problem, there's different ways to solve it, and if we can teach people to be more uncomfortable with discomfort and sitting with there being multiple solutions, I think we'll reduce a lot of the very banal conversations that happen about national issues.
Yep. Well, we definitely need more intellectual courage to confront these things. I guess last question is, you studied classics. How often do you think about the Roman Empire?
I've been tracking this. It's about 15 times a day.
Thanks, Jake.
Thank you.